Good morning, everyone, and welcome to this market update webinar by W1 Group in partnership with Marlborough Group. I can see attendees joined in from locations all over, so we appreciate your time in being with us today. For those of you who don't know me, my name's Jason Nash. I'm a senior financial advisor at W1 Group. We work alongside for just 10 years now. I hold bachelor degrees in law and commerce, a diploma of financial planning, master of finance, and an MBA. I've worked internationally at roles at top tier firms, including Morgan's and a NASDAQ listed company, and worked across Australia, the US, Middle East, continental Europe, and in the UK, where I'm currently based in London. I've been with W1 for a number of years now, and similar to myself, all of the advisors at W1 have strong academic and professional backgrounds, and all advisors, no matter where they are based in the world, have a minimum UK level 4 or equivalent qualification, and most of them are further qualified above that. We're very fortunate here today to have Nathan Sweeney with us. Nathan's the Chief Investment Officer of Multi-Asset. Alongside him is Scott Truter, an investment analyst, both from Marlborough Group, and they're here to give us a market update. Marlborough has won numerous awards and accolades, including Britain's Best Fund, and Nathan manages billions of pounds of funds. So we're very much appreciative of him stepping away from the market screens and to be with us here today. We're seeing some inflation coming down over recent months, the trend consistently coming lower. So we're starting to hear some more positive news from central banks about interest rates leveling out, which we would then expect to see a reduction in interest rates later towards the end of the year. Because of this, we're very bullish on equities in the current environment, and we see it as very opportunistic to deploy capital at the current time. Thanks again, everyone, for joining. Any questions, just type them into the box. You should have it in front of you on the screen. They will come through to both Nathan and myself, and we'll answer them at the end. If we do run out of time, we'll follow up any questions directly by email after the webinar. But for now, I'll hand over to you, Nathan. Thanks very much for your time again.
Perfect. Thank you. So firstly, can everybody hear me? That's the first question we need to check.
Yes, we're all good, Nathan.
Perfect. Okay, good. I think from an investor perspective, there's quite a lot to think about in markets today. So what I wanted to go through was some of the key things or key challenges I think people are facing today. So that's going to be the crux of this update. So as we just scroll through the first slide. Firstly, I just want to talk about the partnership that we have with W1. So I think from our perspective, it's important to partner up with credible companies. And when we think of W1, they're obviously at the forefront of providing financial planning, retirement planning, cash flow forecasting, pension advice for clients across the globe. And from our perspective, what we do well is investment management. So for W1, they want to partner up with somebody who's good at their particular area of expertise, and that's where our expertise lies, so within investment management. And for us, it's about being able to construct and manage portfolios all in one place, and by ensuring that you're getting a diversified exposure to a range of global assets. But, you know, the real thing we want to do is make sure that we're providing that optimum mix so that you're getting a good return for the level of risk that you're taking. So we're always looking to select those best funds, so the best funds in class from around the globe. And we've got a team of 10 different experts whose sole responsibility is to do exactly that, is to search around the globe for the best funds at any particular time and then to put them into a portfolio. So from our perspective, I suppose we're really happy to be working with quite a credible organization, because reputational damage is something that we care about as an organization. So we want to deal with credible people. So let's delve into the presentation itself. So what some of the topics I was going to cover today is, I think, you know, from an investor perspective, inflation is probably the big one that a lot of people are thinking about. And I'm going to talk about why we expect inflation to continue to fall. Then the other thing I think which is a challenge today is we now have interest rates at a higher rate. So that may look attractive because you can get a higher level from sticking your money in the bank. or sticking your money into a money market fund. But is that the right choice? So I'm going to talk about some of the common pitfalls of money market funds, just to explain how they tend to work in different market environments. And then I think if you're looking to invest in a multi-asset portfolio, last year was pretty much a terrible year for investing generally, but I'm going to talk about why we expect to see much better returns going forward. And it generally tends to coincide with interest rates peaking. So I'll talk a bit more about that. I think if we look over the course of the last couple of months, you've probably heard about AI, or artificial intelligence. So I'm going to talk about that in a little bit of detail, just to give you a little bit of background to what's happening in that space and why people are getting so excited about artificial intelligence. And then I'm going to hand over to Scott. And Scott's going to talk about active and passive investing. Because as an investor, people will often say, is it better to invest actively, to select a manager who's picking stocks, or passively to just select a specific benchmark like the S&P 500 and invest in that? What is better? So we're going to tackle that topic. We're going to talk about some of the specific funds that we have in portfolios to give you some examples of the investments that you hold. And then we're going to talk about the performance that's been delivered. And we're going to compare that to some of the other competitors out there, just to show you actually how have we done. So let's roll through onto the next slide, please. So inflation is high, but we expect it to fall. So on the next slide, ultimately, what I wanted to provide here was just some of the key drivers of inflation. Now, I have talked about this before, and everybody's pretty much aware that at the beginning of last year, or even before that, one of the big problems we had was supply chain disruption, because ultimately we were exiting from COVID, and then people started to get back out into the real world. And as a result of that, they were demanding specific product. The issue we had was that for a lot of companies or supply chains, the supply chain wasn't actually fully functioning. And that was because you didn't have enough people in the right place to do the jobs to ensure that the supply chains would work efficiently or function properly. And ultimately, that was because during COVID, a lot of people decided, to maybe retire, or to start a new business, or to change the way that they worked. And, some of these supply chains during COVID reduced. So you can think about, just anything, cargo being shipped across the world. I've talked about this one before. But ultimately, what happened there was a lot of ports closed down. And, we're running at minimum capacity. So when things reopened up, they had to rehire a lot of people. Those people weren't necessarily there at that point in time because they got jobs elsewhere, or decided that maybe they wanted more money to come back to those jobs. So that created a lot of friction, which pushed inflation up. But I think one of the more recent drivers of inflation, because supply chains are now normalizing, is actually food prices. And this chart is interesting because it just shows you that there is actually quite a high correlation between the oil price and food prices. So basically what I'm saying there is, if oil prices go up, it can be a real driver of food price inflation as well. So why is that? And ultimately, all you have to think about is how food is produced. Because if you are basically producing any kind of crop, you need heavy machinery to do that. And if you're using heavy machinery, you're using oil, you're using petrol, and in some of the production of food, you're using gas as well. So generally what that means is that if the oil price goes up by any amount, food prices are linked to that oil price increase by about 65%. So 65% of the increase in food prices can be explained by the movement in the price of oil, which is quite an interesting statistic. So if you are sowing any crop in the ground, you need heavy machinery. If you're watering it, you need heavy machinery. If you're harvesting it, you need heavy machinery. If you're transporting it to get produced, you need heavy machinery. You need machinery in the production. You then need machinery in packaging, and all of this is using energy. And then the transportation, obviously, to the end of the supply chain, which might be the shop. So you can see that there's quite a high impact on food prices because of oil prices. And ultimately, there is a delayed effect. So what we saw last year was higher oil prices because of the invasion of Ukraine by Russia, and oil prices getting up to about $124 a barrel, but they've subsequently been coming down. But you have to remember that all of the input costs, or the costs going into the food that we're getting on the table today, is as a result of those higher oil prices last year, as those crops were being grown and then produced and turned into food. So there's a delayed effect. Now, what we're seeing obviously is energy prices have come down. So we would expect that to then start to feed through into lower food prices. And interestingly, if you look at some of the recent inflation data that's come out, you've seen that food prices have, they've been pretty high, have started to come down a bit. And there's a bit of political pressure there from various different governments trying to encourage shops to try to reduce prices as well, because it's having an impact on inflation in some countries. More notably, Europe. You've heard about all the controversy about pasta prices, and in the UK as well. So on the next slide, what I wanted to do was just talk through some of the drivers of inflation. Now, this is just looking at UK inflation, but it's quite similar to a lot of other regions, because what we've seen is that inflation has the drivers of inflation have changed. So specifically, this is focusing on household and household services, which is the green bar in the middle. And basically what that incorporates is gas prices. So these are these big gas bills that a lot of Europeans faced last year, and a lot of people in the UK. And that caused that component of inflation or prices to go up quite substantially last year. But what you're seeing now is that that is reducing, and it's reducing because gas prices have come down, and therefore gas bills have come down. But I think it's also important to highlight that some of that effect is seasonal. So realistically speaking, it's the summertime, it's warm outside, and therefore people are using less gas, and that's helping to bring the price down. But you've also seen that during the winter months, we didn't really have that disruption to this supply that people were expecting, and therefore that helped prices to come down. We never had the shortages that people were expecting, so that helped prices to come down. The interesting piece for me is that, the big areas that people were concerned about last year, gas prices, transportation costs, food prices, they're now all starting to fall. But what you're seeing is that areas like recreation and culture are starting to rise. So this is things like airline costs. So if you're booking a flight, it's obviously a lot more expensive today than it was last year. If you're trying to go to a hotel, it's a lot more expensive as well. So to my mind, what you're seeing is a lot of these industries are trying to basically recoup some of the losses from the COVID era. So therefore, in a sense, price gouging. So trying to push the prices as much as they can. But because there's a seasonal effect there, a lot of people tend to go on holiday during the summer. There tends to be more demand, so they're able to put up those prices. But what I would expect to see is that the component for recreation and culture will decline as we go through the summer months. And ultimately, what we're now faced with, because we have high inflation, we have higher interest rates. So in a lot of countries, we're faced with higher mortgage costs. And a lot of those mortgages renew over time, because people might fix for 2 years or 5 years, depends where you are. In the US, it could be 30 years. But there's a lot of mortgages up for renewal imminently. And ultimately what that does is it takes away people's purchasing power. So you had more money to spend on recreation, but when you renew your mortgage in September, you're going to have less. And in a sense, this is what governments want to happen. Because if you're spending less, that helps to drive down inflation, because it brings back price competition. Because if you spend less in the shop, then the shop has to attract customers, and the way they do that is by reducing prices to entice you to spend money. And also what the government tries to do to take money out of the economy by raising interest rates, you then think, well, maybe instead of spending my money, I'll put it in my bank account. And that's the other mechanism. Unfortunately, what this tends to do is it tends to drag on economic growth. So this increases the potential for a recession. So you'll see a lot more chatter in the media about the potential for recession. And yesterday we had inflation figures in the UK. They came out at 8.7%. They were 8.7% the previous month. They hadn't fallen. So now there's an expectation that the Bank of England will raise rates, which they're likely to do today. And they might even raise them a bit more. And therefore, that could lead to a recession. So these are the things the market's worried about. I'll talk about why that's something that the actual stock market is less worried about when I come on to a couple of more slides. But on the next slide, what I wanted to do is just try to highlight the fact that inflation is likely to continue to fall, because ultimately, when you look at history, when inflation goes up, it goes up for a period of time. And basically what they say is that the rise and fall of inflation is symmetrical. So it creates a similar shape. So think of it as a bell curve or a histogram. So what we can see here is this is showing you inflation in various different countries around the world. And when it was light blue, inflation was low. And then obviously as inflation increased, it went from light blue and it went red, etc. But if you count up the number of months on the chart, you can see that on average, it was about 15 months between the low point to the high point, so trough to peak. And what we can see here is that, if you look at the Eurozone as an example, we had inflation getting up to 10.6%. If you look at the US as an example, and that was in October, and if you look at the US as an example, it got up to 9.1%, and 9.4%, and that was back in June. So the US was ahead of everybody because they reopened their economy first. Everybody's tried to go out and spend. You had supply chain disruption, prices went up. But they were the first to then see their supply chains normalize, because then they hired people into those jobs, which helped everything to run smoothly again. And you can see that inflation has now fallen. Now, it's not going to be a fall every single month. It just goes down. There will be an ebb and flow. So 1 month down, next month up, down, up. But it's kind of a lockstep down. So you can't expect perfect data every single month. But what you're seeing is that inflation is falling. And I suppose the thing to take away from this is that it rose for about 15 months on average. So we would expect it to take about 15 months on average to fall back to where it was. The reasons we believe it will fall back to where it was is, some people believe that possibly we're going to move to an environment where inflation is structurally higher. And the reason they say that is, well, firstly, you might have a wage inflation spiral. So what does that mean? So ultimately, when you have inflation, costs of goods go up, you're employed, and now it costs you more money to buy the stuff that you would normally buy. So you're out of pocket. So you go back to your boss and you say, I need a wage increase because my costs have gone up. Costs have gone up by 10%. I need a 10% wage increase. So your boss says, okay, that's fair. I'm feeling inflation too. Everybody needs to get that wage increase to get them back on the level. But then the shops realize that everybody can afford those higher prices. So what they do is they try to push it and go, we'll increase them again. So you go back to your boss, but that strategy doesn't work. So your boss isn't going to say, yes, we're going to give you 5, 10% every single year. Now, historically, what happened was, if I was to ask the people today who are listening in, were any of your parents in a trade union? It's likely that a high number of you would say, actually, they were. Whereas if I was to ask you, are you or is your partner in a trade union? The answer to that question is likely no. And the reason is that a lot more people work in the service sector, and they work in companies that generally pay you a salary which gets a increase once a year, normally January to March. Now, back in the 70s and 80s, you had a lot more people in trade unions, which meant that when there were issues, they went on strike, and normally then the companies would have to give in to those demands and pay those higher wages. But because less people are in these trade unions today, it means that we're less likely to get this wage inflation spiral. So I don't know about you, but so from our perspective, we stuck with that trend, and a lot of companies would have done that, giving that similar pay rise that people would expect to see, that 2 to 3% a year. So I think structurally, the drivers of wage inflation today are different to the drivers in the 70s and 80s. However, from a media perspective, it makes a lot of headlines because the people who are in trade unions provide some of the services to keep, the basic economy functioning, things like hospitals, transport. So it's hospitals in the UK because of the NHS, but transport like trains, etc. So therefore, it does create some friction. But however, it doesn't really impact productivity too much because of the way that we work today. We can do a lot of the work online. So there's less of an impact from that perspective. So for that reason, I don't believe we see structurally higher inflation. And then the other reason people cite is the fact that you have more conflict between countries. So you can see the language between China and the US. There's a bit of conflict there. And if you have conflict, that could lead to trade restrictions. And if you're forcing countries to trade with other countries where it's more expensive, that will push up prices. But again, I don't really buy into that because ultimately companies are in the business of making money and they will source cheaper production elsewhere. I can give you a good example of, say, the iPhone, where they produce a lot of their components in China, but they actually now produce about 7% of the iPhone components in India. And they have come out recently to say that they're going to increase that. So this is a way of reducing cost, and a lot of companies are moving production from China, as an example, to countries like Vietnam. And again, that helps to reduce costs, which helps to reduce inflation. So I don't think we're in a world where production can't go to a country where it can be cheaper yet, because you would need to be in a world where the whole planet is developed and the whole planet is providing services opposed to the manufacturing. But with the development of any economy, it tends to start off manufacturing more, and over time those jobs move to higher skilled jobs as the economy grows and more people get educated and end up in the service sector, and ultimately then that leads to a higher level of services within the economy, and then you see those manufacturing jobs move elsewhere. So that trend can still persist. So I don't see structurally higher inflation. So hopefully that just gives you a bit of insight into inflation and the expectation that it will continue to come down. And if you look at inflation data in Europe, it's now got a 6 in front of it. In the US, it's got a 4 in front of it. In the UK, it's slightly higher at 8.7%, but it's been coming down. So we continue to expect that to happen. Okay, so the next thing I was going to talk about is money market funds. So on the next slide, I think ultimately from a client's perspective, what you will see now is a lot of offers on the high street talking about money market funds. And the reason they're talking about money market funds is because interest rates are higher. So I was trying to think of an analogy for this. So ultimately, when I was deciding to get married, I had to go out and buy an engagement ring. And obviously, it's something that you want to get right. It's a big decision. So what I did was I looked at a lot of the high street shops, and I just felt that there were a lot of offers similar to money market funds today. But I felt that I wasn't getting real value for my money. And somebody had mentioned to me that you can buy rings at an auction house. And I thought, is that a risky strategy? Because I didn't really know much about buying anything at an auction house. But ultimately, I did a bit of research, and you have various different auction houses here in the UK. So they have a jewelry auction at Bonham's Auction House every couple of months. And basically, it's a lot of jewelry that people are then passing on and auctioning basically over time. And ultimately, you can find yourself a real gem. So you can get a real good diamond, hand cut, quality material, worth a lot of money, but you're getting it at quite a discounted price. And so what I did was I went along to this jewelry auction, and the bidding started. And before the bidding started, I had a price in my mind. Okay, I'm not going to go higher than this. This is what I think it's worth. But ultimately, you had bidding started. I have bids in the room. There was bidding online. There was bidding on the telephone. And a lot of the bidders then fell away. And it was me and another guy bidding. Now, suddenly we're approaching my cap. So I'm starting to get a little bit worried at this point. So what I do is I look over at the guy, and it kind of dawns on me that I'm bidding against a professional jewelry buyer. So this guy's day job is to buy jewelry, bring it back to his shop, and then sell it at a much higher price. So I'm thinking, okay, well, whatever price I pay, I just need to go one bid higher, because I know that it's worth a lot more, because this guy is obviously going to try and mark that up by 20, 30%, if not higher. So I'm getting a good deal. So I got the ring, but the auctioneer pointed his gavel at me and he said, "Well done for holding your nerve." So the reason I tell that story is because I think there's some parallels to what's happening today within markets. Because for money market funds, it's almost like the high street offering, and you're going to see a lot of high street offers saying you can put your money in the bank and we can, put it into this product here and maybe lock it away for 12 months and you can get X interest. But I suppose the real question is that helping you to reach your financial goals? And is that an investment that's truly going to be worth something over the long term? Because when I brought that ring in to get it valued, the value of it is substantially more than anything I could buy on the high street. I got more carats, it's 1920s, it's hand cut. So, it's really something that you can treasure and hand down to the next generation. Where the real problem with money market funds is people tend to allocate to them at the wrong time. So on the next slide, it kind of just highlights one of the reasons why people might allocate to a money market fund. So it's usually due to uncertainty. And what we had earlier this year was we had the collapse of a bank called SVB, Silicon Valley Bank. And what that did was it kind of reminded everybody around the world that there's the potential for a financial crisis or some sort of problem within the banking sector. So people's minds directly go back to 2008, because it's human nature. You anchor to that event and you think it's 2008 all over again. But the reality is it's not. And the reason it's not is because in 2008, you had a situation where we did have a banking collapse. We had a real problem in the banking sector. But what happened then was all of the central banks around the world basically came up with a way of solving that problem. And governments intervened and they provided support and they helped banks. So what they were doing at that point was they were creating the blueprint to be able to deal with any issues in the banking sector swiftly should they happen again. And so for me, when SVB Bank collapsed, what you found was that the US government and the regulators were very swift to act. So they stepped in within 24 hours and told everybody, your money's in the bank, it's there if you need it. Now, the reason they did that is because ultimately the financial system is the heartbeat of the economy. So why do I say that? Because what it does is it provides a network for getting money around the economy, so it keeps the economy moving. And if you have issues with the banks and people are concerned about the banks, then that money stops moving. So from a government perspective and central bank perspective and regulator perspective, they really understand that and they understand the importance of that. So they were very swift to act. But the same with Credit Suisse and UBS. Over the weekend, a deal done, sorted, fixed. Because again, they wanted to ensure that people were not concerned about financial instability. So that's one of the key things that central banks are supposed to do: manage inflation and ensure that you have price stability, as they call it, just a stable economy, a stable banking system. So from my perspective, I'm not concerned about the banking system because I know that the central banks and governments will act quite quickly should there be a problem. And already to some extent, there's less concerns now about the financial system. Banking stocks are starting to recover. So that's almost behind us. But on the next slide, I just wanted to highlight what tends to happen with money market funds. So for money market funds specifically, you tend to find that people allocate more at times of stress in markets. So if you think about 2000, you can see a pickup in allocation to money market funds. So this slide is just showing you allocation to money market funds or cash funds or funds paying interest over time. And the line goes up, but it spikes at points of stress in markets, because when people are concerned with markets, they then make the rash decision of, got to take the money out, there's a lot of bad stuff happening, and stick it into a money market fund. But the irony is that most people tend to allocate after the event. So after you've had the risk event in markets, which was last year, rising interest rates, big inflation, then you see a spike in that allocation and a continuation of the allocation into money market funds. Now, what tends to happen then is markets recover. And then people start reading the news about the fact that we're in a bull market and we've got AI and technology stocks are up X amounts. But I've locked into that 12-month cash fund, and well, you know, I can't get my money out for 12 months. The market's gone up. And this tends to happen time and time again because retail investors tend to be very sensitive to what's happening in the media. And the media obviously tends to, I suppose, increase the volume around the point of an event. And, you know, so that can exacerbate things. And ultimately, it's after the horse is bolted that you're reading that information. And the market is thinking ahead and moving on to the next thing. Because I've got a slide which shows you kind of it demonstrates this in a bit. But I just wanted to highlight that that was something to be mindful of or wary of. And then the other point is that some people then start to allocate back into the market because you can see, obviously, it peaks and then you can see money coming back out. But it never gets back to the level where it started before because some people just get scared out of markets entirely. And ultimately, that's not a positive thing because the reason people invest is because investments do go up over in time. The reality is there is volatility as part of that. And some people can't stomach the volatility because that volatility is exacerbated by the media. And that prevents you from meeting any financial goal that you have. So maybe you wanted to send the kids to university, maybe you want to retire early, maybe you want to pass on money to the next generation. It's harder to do that with this type of product because over time, what happens is the economy recovers and interest rates fall. So then you're getting a lower return on this investment. And as interest rates fall, that tends to drive equity markets even higher because ultimately, as interest rates fall, it reduces financing costs for companies, which helps them to make more profit. So I just want to highlight because I think it is one of the pitfalls and it only comes into view, this type of product, at the wrong time, and it happens all the time. Okay, so on the next slide, I was just going to talk about 60-40 portfolio. So this is your average multi-asset portfolio. And your average multi-asset portfolio tends to invest in equities and bonds. And when you have rising interest rates, that tends to be a terrible market environment for equities and bonds. So last year was no different. So you saw a substantial sell-off in equities and bonds. Now, this is just showing an average portfolio. It's based off of the S&P and it's based off of bonds. It's not showing you the actual return you would have received from investing in our product. The drawdown was nowhere near this, less than 10%. But it's just to highlight the point that when you get extremes in markets, the market tends to overreact. So therefore, that provides the springboard for it to recover. And I'll show you later on the presentation performance of markets here today. You can see the difference in performance already. And you know the key driver of that are things like what's happening in the economy, what are companies' earnings, and what are central banks doing with interest rates. They tend to be the three key things which drive that. But I suppose anecdotally, when you do get those sell-offs, they are followed by recoveries because you get this thing called mean reversion. You revert back to the mean or back to the average because things have oversold too much, which is just a human behavior. So sell everything, figure out what's happening, and then we can reassess. It's not great strategy, but that tends to be how markets work. Okay, so on the next slide, I think one of the key drivers of basically markets are interest rates. And ultimately, when you see a peak in interest rates, generally 12 months after that peak, this is showing you the returns that you get in both equities and bonds. So it's looking at 1 year after the peak, 2 years after the peak, 3 years after the peak. What do those returns look like? So for the US, it looks like we're at peak interest rates. In the UK, it looks like we've got a rate hike today. And then we don't get inflation data. I think the next data is in August that we get. So it skips a month. So ultimately, it's likely that inflation comes down between here and then. And that provides the central bank with an opportunity not to raise interest rates because they don't want to raise interest rates because they know the impact it's having on the housing market. But politically, they're handcuffed because everybody's wondering, what's the government doing about this cost of living crisis and this high inflation? So they have to raise interest rates. So politically, they're in a position where they need to do it because they have to be seen to be doing something. But ultimately, you know, the language that was coming out of central banks was hinting at the fact that they would have preferred to stop raising rates earlier, but needs must. But I suppose the key point here is that we know that interest rates cause markets to sell off like it did last year, but we know that when you get a peak in interest rates, you get more certainty from companies because they know exactly what cost they're dealing with. So if I know what cost I'm dealing with, I can factor that into what we're trying to deliver as a company, what kind of earnings we're going to deliver, what kind of strategy we're going to have. We know exactly what that fixed cost looks like. But last year, as interest rates went up and up and up, we didn't know where they were going to get to. And that made it more challenging for companies to know where we exactly were. So this gives you a bit more certainty. And the reality is when you get a peak in interest rates, the next move is down. And, you know, if you look at cycles of rising interest rates going back 30, 40 years, you can see that on average, within 6 months of the peak, you get the first cut. Because what's happened is the central banks have generated an artificial recession. Because they've raised interest rates, they take money out of circulation. They've increased my mortgage. They've caused people to save more. Therefore, there's less money in circulation. So the economy shrinks. It creates a recession. To kickstart the economy, they do the opposite, lower interest rates. So we do expect towards the end of this year, you'll start to see some action on that side. Each country will be slightly different, the pace and when. And, you know, ultimately, if economies are actually chugging along and everything's okay, then that's not a bad scenario either, because companies will still be able to generate profit in that environment. On the next slide, you know, I've mentioned the fact that this year is actually better already. So we saw that sell off last year, but this shows you performance year to date. And I've just got a number of different benchmarks here just to kind of illustrate that point. So I've got US equities, and you can see that they're showing a much better return this year compared to last year. You've got UK equities, European equities. You could look at any region, really. So Japan is positive, Asia is positive, emerging markets. All equities are doing better. Why is that? Because the equity market is essentially trying to look forward. It's saying, okay, markets sold off because interest rates went up, which increases financing costs for companies. Therefore, their profits will be lower. So therefore, the share price should be lower. That's why they sold off last year when we started to get the first interest rate cut, because they knew that would impact company earnings in the future. So now what we have is company earnings are now coming out weaker, but they're not as bad as we expected. And they're not as bad as we expected because there's so much pent-up demand post-COVID. People have got lives to live. They've got things they want to do. And they actually saved up a lot of money. So all of that is competing against these higher interest rates, and this side is winning. So ultimately, what you should expect to see is that equity markets are doing okay. And the bond markets is the other piece. So they tend to do better as interest rates start to fall. But now that rates are higher, all of these bond instruments pay you a higher level of interest. So you're being paid to hold those those investments now, which are giving you a higher rate of interest. So the returns are not as high as in the equity side, but they'll start to deliver more when interest rates fall. And actually, now that they have a higher level of income on offer, they can really help if markets did fall, because ultimately they would counterweight what's happening on the equity side. So we do expect much better returns for 60-40 portfolios from here, because of the potential for rates to come and the fact that rates have stopped rising. Okay, so that just gives you a little bit of insight into 60-40 portfolios. So on the next slide, what I wanted to do is just talk about the what next for markets. Okay, so if we look at this slide first, so I talked about money market funds, and I talked about the fact that people tend to allocate at the wrong time. So the gray bar here shows you the S&P 500, which is a benchmark, which is basically just the top 500 companies in the US and the average price movements of them over time. And it obviously goes up and down and up and down, but the general direction is up. So my analogy there is like walking up the stairs with a yo-yo. There are ups and downs along the way, but the general direction is up. I'll talk about why markets go up in a second over time. But the interesting piece for me is that it also shows you flows in and out of funds and ETFs in the US. So it's a way of gauging retail appetite for investing. And ultimately, whenever you get a sell-off in markets, what you tend to find is then people start to take their money out. Interestingly, you can see an acceleration in sell-offs after you've hit the bottom. So it's almost like that money market piece. So allocating to that money market fund after the market has bottomed, when actually, back to the analogy about the ring, I'm getting something cheaper. So the professional buyer is looking at the market today, whereas the retail buyer is looking at the high street. So they're looking at basically the money market offers, whereas the professional buyer is looking at the equity market, because they know that if something sells off, it's cheaper, and that's a good time to buy, because ultimately you're getting it at a cheaper price. And as this cycle goes through its natural course and interest rates come down, those companies will generate more profit and share prices will rise. Why would I sell something which is now lower? I should be buying more of it. So it's like getting the discounts in the shop, the 2-for-1 offer. You don't just buy the one, you buy the two. And the whole point here is that pattern repeats itself all the time. And this is the folly of the retail investor. And a lot of that can be blamed on the media, because what they tend to do is over accentuate the issue. So we talked about the fact that that bank collapsed, and I told you the central banks have a blueprint. So I'm not worried about that. The professional investors aren't worried about it, but the media will make that into it's the end of the world. And that's the challenge we have today, because that's the world we live in, where the media is overly pessimistic all the time. So that helps, any individual have a risk-off slant. And you can't help that, because you're just being peppered with the bad news all the time. So from our perspective, what we try to do is just remain grounded when it comes to investing, try to shut out the noise and focus on the data, focus on the numbers, and try to understand what is happening, and do research to understand what is happening to enable us to make grounded, sensible investment decisions. Okay, so on the next slide. So ultimately what we have here is we have, it's showing you economic growth. It's showing you inflation and interest rates. And the reason I have that here is because it shows you the 3 key drivers of returns for markets. So what's happening in the economy can be a real driver of markets. What's happening with inflation can be a real driver in markets. And what's happening with interest rates can be a real driver. So in 2021, we had really good economic growth because we were coming out of an environment where we had COVID. And ultimately, that meant that growth is really strong, good for markets. We had no real inflation. We had interest rates low. And you can see the return in markets was quite strong. Whereas in 2022, we had the opposite. We had a slowdown in economic growth post-COVID. We had inflation, which was extremely high. And then we had aggressive rate rises to tackle that inflation. And that's generally a bad period for markets. So people are often wondering, so why is the market going up this year? Because people are expecting this big bad recession because of all the interest rate rises last year, and it hasn't materialized because, as I said, we had this structural driver, COVID. You can't lock the world down for 3 years and expect no impact. It's like having a global war, because everything stopped to a large extent globally, and then you're just going to have a boom for a period because you obviously have all of this pent-up demand. And if you think about anything, if you've got kids and they were trying to get to university, or people are trying to move out, trying to move house, there's a backlog of things that need to be worked through, and that's just creating demand and growth in every single sector across the world. Then you have inflation, which is obviously been coming down. So it's not going up anymore, and it's coming down, and that's good news for markets. And interest rates, we're at the end of this tightening cycle. So it's likely peaked in the US and the next move is down. And that's what the market is looking at. It's not looking at all of the news in the media. So just important to highlight that. And then the last thing I was going to talk about was artificial intelligence. So I kind of hinted at, why do markets go up over time? So, if you were ever wondering what the secret sauce is for markets to go up over time, why does it happen? This is the answer. So ultimately, it's due to change in technology. So something comes along, which is a game changer, which changes the way that we work, which changes productivity, and does it massively so. And over various different decades, you've had something that's come out which has done exactly that. So whether it's railway, whether it's airlines, whether it's the car, industrial revolution, the internet, now we've got artificial intelligence, automation, we've got clean technology, robotics, all of these new techs coming through, and they're going to be a driver of increased productivity. And if you can increase productivity, it means you can increase profits, which enables share prices to go higher and companies to generate more money, and therefore asset prices go up. So I think it was Goldman Sachs who came out with a statistic saying that about 60% of all jobs globally can be impacted by some kind of automation. So it's a big, big number. And about 40, if not higher, % of that workload can be automated. So I think if you think back to the 1950s, 70% of the jobs around the 1950s do not exist today. If you go to the airport today, you check in using a computer. If you go to the shop today, you can check out using a computer. So what you see is just a continued automation. So AI, artificial intelligence, is just enabling computers to go faster. It's enabling computers to get smarter, and therefore it's enabling them to do more of the work that we do today. So if people were to ask you, what do you do? I think most of you work in a specific profession, but the reality is most of us work in administration because there's so much administration that comes with the jobs that we do today. Now imagine a world where artificial intelligence can take away a number of those tasks. And that's what AI has the potential to do. So I can talk about NVIDIA for a second, and I'm just conscious of time here. So NVIDIA came out and their profits were extremely high, and they've come out and expected to generate even more profits. And there was big news about the share price. So they generated revenue of 7 billion. They're saying next quarter, we're going to make 11. So what that shows you is that the hype about AI is actually real, because what they produce is a thing called a GPU, which is a graphic processing unit, which just helps with visual effects. And, on your computer, everything is visual. It helps with, running the system quicker. So it can make a computer 10 times faster. So when your kids are playing video games at home and you look at the graphics and go, wow, that is incredible, because it is, it's because of the GPUs that NVIDIA make, which enable computers to go much quicker. And then other providers are thinking, well, we could use that for processing data. And if we can process data quicker, then we can do a lot more. So I don't know if anybody's used Chat GPT, I'd recommend just having a look. But if you ask this thing a question, basically it has a database of 8 million websites and it can curate the perfect answer within seconds. The instant you press, enter, it scrolls out a long ream of an answer, and you could ask it to write a 1,000-page white paper on X versus Y, and it will do it in a matter of seconds. And you will read through it and go, that's pretty impressive. And the whole point there is that enables everybody to be a little bit more productive. So if we can learn to use these tools, we can get better at our jobs. And what you'll find over the next couple of years is a lot of companies are going to find very creative ways of integrating this into the way that we work. And that creates an advancement in technology, which then enables markets to go further. So that's just a little bit on that. On the next slide, I was just going to hand over to Scott, and he's just going to talk a little bit about active and passive investing, because I think as an investor, this is a question that often comes up. So thank you for listening to the first bit of the presentation, and over to you, Scott.
Thanks, Nathan. So in this section, I'm going to talk about this topic that probably comes up in the media quite often, which is better, active investing or passive investing. So passive, we're thinking of indexes or exchange traded funds, that's ETFs. So we've done some research and looked at some data, and then we're just going to go through what we think about it and how you can potentially use both active and passive. Just to cover the terminology, a passive instrument is something that looks like a basket of securities that aims to mimic or follow a typical benchmark or index with quite little deviation, so not moving away from it too much. Just think of it as a copy or a replication. Active managers is where you're appointing a fund manager. You want to use their knowledge, their skills, their experience, and parts of their team to tilt the portfolio to areas that might outperform. So Is that a bias to a region, a specific sector? They may just pick underlying companies, but then their aim is that that will perform better than that benchmark or that index. So I suppose, how does that work in practice? So on the left-hand side here, it's got 10 years worth of data, which from a Financial Times article. So it really shows that it's quite mixed. And in the US, it's quite a low proportion of managers, active managers, that outperform their benchmark. So for the US in particular, if you think of the market and how that's made up, there's a number of very, very large companies in the US that have a huge sort of market cap and value. So it's quite difficult for active managers to be overweight or have more of a bias towards those stocks because of concentration rules and limits. So that makes it quite difficult to outperform in that area. But you can see it varies in other markets and regions, and it's a bit more positive as you go to the bottom of that list. An example, the UK, where you're seeing over 60% of active managers outperforming in that period. So that made us think, really, how do our funds that we're looking at, the active funds that we choose, perform? So we started to look over a 1, 3 and 5 year period at the performance to see how they outperformed. So these funds are on our buy list that we use and include in the models and include in our fund of funds. So we were really pleased with the results. And I think that highlights how our process and what we talk about and the structure that we have in place as a team delivers on these outcomes and this good selection. And that's not just picking them from the start, that's thinking of ongoing management and movement of those funds and how they work in the models. I suppose that comes into a question is there room? Do we need to have passive funds? We think you do, and we think they add a good option and tool within portfolios. But similar to active managers, there's still a lot of research that you need to do because there's so many different areas, different benchmarks, different indices that you may need to use. There's probably hundreds, if not thousands. So how do you know you've got the right one for the job? And this next slide I'm going to go on to sort of talks about the differences, more specifically in the US, but just hopefully highlights that. So the red line is the S&P 500, which you've heard Nathan mention, probably the most commonly used US equity or stock index. So if you held that and you'd picked that as an asset, your passive investment, you know, of the last year, which is that left chart to the end of 2022, that would have been down just over 6%. And then this year to date, it would have been up just over 9%, just coming to 9.5%. So you can see how that performance. But then the blue line, so on that bottom one on the left chart, is the NASDAQ. So that's the more tech firms and companies. So you can see if you held that last year to the end of 2022, you were down over 25% in that index and following that. On the other side, you've also been up more than 30%. So a lot more volatile journey. And just to explain that, and I think Nathan touched on it before, is that when interest rate rises are going through the system, they obviously impact companies because it impacts their borrowing costs. That tends to mean tech firms are more susceptible because they're often trying to grow their business, innovate, and look at new technology. So you see them impacted more. On the flip side, so that yellow line at the top is a quality dividend index. So that focuses on bigger companies, strong balance sheets, good cash flows, paying out dividends, often have good pricing power. And so when you think of that, that makes sense. So if you've got interest rate rises and companies may be struggling from borrowing costs, you might want to tilt to those stronger companies that you think can weather that storm. And that reflects in the performance. And that's what happened last year because markets are trying to look 6 months ahead. So all that negative performance was in 2022 for those tech firms that were impacted or going to be impacted by the rate rises, and the quality companies perform better. You go to look at the chart on the right, this year to date one, which is up to about the 12th of June, and those tech firms are performing better because the interest rate rises have peaked or were not far off. And again, the market's looking 6 months ahead and thinking about those rate cuts. And obviously that benefits those companies. So you can see the difference by tilting the portfolio, and that, you know, individuals that may invest and like those tech firms, you know, could have a very difficult experience and potentially time the market wrong because it's very difficult to pick out all these peaks and troughs and how the performance. So what we look to do is rotate the portfolio between these elements to provide better performance. So last year we had more of those value and quality type ETFs and exposures, and then we've tilted the portfolios across to have a bit more of those tech names and those core exposures that have performed better year to date. And so that's the benefit of having a sort of a multi-asset approach, and obviously not just focusing on one region like the US, but doing this across other regions and considering how the markets move. And that's very important. So we think there's both active and passive strategies you can use in the portfolios. These next couple of slides just show some of these active funds that we have in the models at the moment and how they've performed. First one is the Fidelity Global Technology Fund. So this was added into the models towards the end of last year. The manager was new starting at Fidelity in 2012, and Fidelity gave him some of their own money to manage as a sort of to prove themselves that he was good at that role. He did that and it worked well. And so they launched that strategy, which he managed from 2013. And you can see has shown significant outperformance. Focusing on tech companies, but also not all of the large ones, and has some mid cap, but they're still more advanced than maybe you would think of a small startup. And so those mid cap ones are still multi-billion-dollar firms. And so they have a real mix of exposure. And that has proved well, not just the short term in those year-to-date numbers, but also long term through the track record of the fund. Another one is a UK equity fund, the Even Load Income Fund. So this is a large cap quality fund, likes companies with low leverage, good market power and pricing power, durability to those products. So good in a high inflation environment, and that's proved well. As you can see from the chart, but not just from a short term, again, a longer term perspective. So that strategy has been running since 2019 and has outperformed the FTSE All Share in 12 of the 14 years that it's been running. So really good, strong track record, downside protection. What's probably interesting is, even though the UK potentially has some headwinds and more challenges, when you think of those FTSE 100 companies or the bigger companies in the UK, a lot of their revenue derives from global demand and supply there. So what it means is it's not just susceptible to the UK consumer and UK domestic output, it's got a wider reach there. So we think that can continue to perform well. And then just this last section to bring it sort of all together in terms of the performance of the models and how they've looked, because we appreciate that's important. So here we've got the example of the balanced portfolio, and it just shows you some other competitors that run similar portfolios. So what we're trying to highlight ultimately is if you have a robust investment process, it can deliver strong outcomes. And if you're disciplined with that approach and you continue to review and refine that, we're getting these good performance outcomes for the clients. And not just thinking from a performance, but thinking from a risk and volatility perspective. Just to move on to this slide, this shows risk reward outcomes. And if we focus on the middle one, because that just links to the balanced portfolio I showed you on the slide before, across the bottom is how much risk a portfolio takes. So towards the left, it's less risky. Towards the right, it's more risky. And so whilst we're looking at portfolios that do a similar job, how you create them and how much risk you can take within them can be different. So what we're highlighting when we're just thinking about this balanced one is that we're trying to take less risk and consider that from a client outcome and a downside protection perspective. But then looking up the chart on the left one where it has return, deliver those higher outcomes. And all it shows you is those three models. The axes and the scale is the same. So you can see as you step through, you're taking an increased amount of risk or maybe a bit more volatility, but also delivering higher returns. So I am conscious of time, but that just gives you hopefully an overview of how we think about markets, what we're doing specific on our portfolios and how they've been performing. And so I'll hand back to Nathan or Jason, and if there's any questions.
Perfect. Thanks for that, Scott. Thank you, Nathan. I'm very conscious of time as well, so I'll just wrap up by saying we appreciate everyone putting aside the time and joining us today. We have had some questions come through, but I've passed those on to the relevant advisors of the clients that have sent those through. So they'll be followed up directly from your advisor. If anyone has any questions after the event, feel free to email your advisor and we can answer them there, and also distribute the recording if you wanted a copy. Thanks again, Nathan. Thank you, Scott, and for all of our attendees. Bye now.
Thank you. Bye-bye.
Thanks.